There's a moment in every cycle when markets stop believing the story they were told and start believing the data instead. This week was that moment. US Treasury yields suddenly spiked, not because inflation exploded, not because the economy is booming, but because the Federal Reserve sent a message that markets did not want to hear: no rate cuts anytime soon. Within minutes, yields jumped across the curve. Global equities fell, bond markets shook, and the entire financial system repriced itself in real time. We've seen this setup before, in 1994, in 2000, in 2007, in 2013, in 2018, each time the pattern didn't drift. It snapped. Today, the US debt system has entered what I call Stage 4, systemic stress recognition, and if history is any guide, Stage 5 is not far behind. This is the story of what just happened, why yields are spiking now, and what the last 30 years of market history say happens next. Over the last 72 hours, global markets experienced something rare: a synchronized repricing of risk across almost every major asset class, according to multiple reports from Reuters. Global equity indexes fell sharply as investors dumped risk assets and piled into cash. After Federal Reserve officials crushed hopes for a December rate cut, Treasury yields turned higher immediately. The Financial Times noted that Wall Street slashed its expectations for a December cut, from well above 70% just a week ago, down toward a coin flip, after a wave of hawkish comments from policymakers including Susan Collins, Neil Kashkari, and Jeffrey Schmid. They all delivered versions of the same message: inflation progress is fragile, the job is not finished, and it is too early to commit to more cuts. In another Reuters breakdown, analysts described the odds of a December cut as on a knife's edge, with several Fed officials warning that easing too much or too soon could reignite price pressures. Markets moved fast. The 10-year Treasury yield pushed back toward roughly 4.1%, its highest level in about a month. The 2-year yield, which tracks Fed policy expectations most closely, spiked as traders abandoned the easy money narrative. Asian stocks joined the sell-off. European markets followed, Gulf exchanges turned red, and bond traders were reminded, once again, that the Federal Reserve still controls the gravity of this system. What triggered all of this was not a new data release. It was a sentence. In his recent press conference, Jerome Powell made it clear: a further reduction in the policy rate at the December meeting is not a foregone conclusion. Those words were enough to move tens of trillions of dollars in global assets. To understand why, we need to step back from this week's headlines and look at the pattern that sits underneath them. Every debt-based system follows the same sequence. Not because politicians want it that way, but because math pushes it. The sequence has 6 stages. Stage 1 is cheap money, interest rates are low, liquidity is abundant, credit flows freely, everyone feels clever. Stage 2 is leverage accumulation. Households borrow more, corporations borrow more, governments borrow the most, balance sheets stretch, because the cost of debt still looks manageable. Stage 3 is early fractures. You start to see pockets of stress, a failed lender here, a struggling sector there, inflation shows up, some assets wobble. But the narrative remains calm. These are isolated issues, not a systemic problem. Stage 4 is where we are now, systemic stress recognition. This is the moment when markets stop debating whether stress exists and start arguing only about how bad it might become. We know we are in Stage 4 because the indicators are textbook. Treasury market liquidity has weakened, bid-ask spreads are wider, and it takes more price movement to clear trades. The Federal Reserve's reverse repo facility, once stuffed with excess cash, has been draining toward empty, showing that easy liquidity is gone. Foreign buyers, especially large holders like Japan and China, have been reducing their treasury exposure over time. The interest cost on U.S. government debt is accelerating rapidly, with every 1 percentage point increase in yields adding roughly $300 billion in annual interest expense. Corporate refinancing risk is rising as loans and bonds issued during the zero-rate years roll over into a much higher rate world. Commercial real estate and weaker credits are already feeling that squeeze. These are not opinions, they are conditions, and together, they form the fingerprints of Stage 4. We have seen those fingerprints before. In 1994, the so-called Great Bond Massacre began the same way. The Fed tightened more aggressively than markets expected, yields exploded higher, bond prices crashed, losses were estimated at more than $1.5 trillion globally. Orange County, California, loaded with leveraged bets, went bankrupt. What looked like a technical adjustment to interest rates turned into a brutal stress test for anyone who had believed the good times would last. In 2000, just before the dot-com bubble burst, you saw the same pattern. Liquidity tightened, yields moved in ways that signaled stress, leverage that had seemed safe when money was cheap became a problem when funding costs rose. The equity crash that followed was the symptom, not the cause. In 2007, in the run-up to the global financial crisis, the yield curve inverted and credit spreads began to widen. Banks and regulators insisted the system was sound. Within months, it was obvious that it wasn't. In 2013, the taper tantrum showed how sensitive the world had become to a single change in tone. All it took was Ben Bernanke hinting that the Fed might slowly reduce bond purchases. Yields spiked, emerging markets saw capital flight, currencies tumbled. It took years to fully stabilize. In 2018, Jerome Powell said that rates were still a long way from neutral. Markets heard one thing: higher for longer. Equities dropped about 20% in a matter of weeks. By early the next year, the Fed was forced into a rapid U-turn. The pattern across all of these episodes is simple. When yields spike after a hawkish pivot from the Fed, something breaks. Not sometimes, not occasionally, every single time. So what does the data say right now? The 10-year yield climbing back toward the low 4% range may not sound dramatic on its own, but the context matters. We have just come through one of the fastest tightening cycles in modern history, on top of the largest debt pile the United States has ever carried in peacetime. The 2-year yield, which tracks expectations for where the Fed will keep its policy rate, jumped as traders rewrote the path of future cuts. The CME FedWatch tool shows how quickly the story changed. Only days ago, markets were pricing a strong probability of a December cut. Now, those odds have dropped toward a coin flip. Mortgage rates, which had only just begun to ease, are vulnerable to another leg higher. Every uptick prices out more buyers and puts more pressure on already fragile real estate sectors. Corporate bond spreads are starting to widen again, especially in high-yield and lower-quality credits. That means refinancing is becoming more expensive just as a wall of debt issued during the ultra-low rate period comes due between 2024 and 2026. Treasury auctions are sending mixed signals. Some are well supported, others show weaker demand and lower bid-to-cover ratios. That matters because the U.S. government now needs to refinance an issue on the order of $9 to $10 trillion of debt per year. With total federal debt above $35 trillion, every 1 percentage point increase in the average interest rate adds roughly $300 billion to annual interest payments. Those numbers crowd out other spending and eventually force hard choices. This is what Stage 4 looks like in practice: yields rising, liquidity thinning, and the cost of debt starting to bite. If this really is Stage 4, the next question is obvious: what does Stage 5 look like, and how do we get there? Stage 5 is the liquidity intervention cycle. It is the phase where stress is no longer abstract, something specific breaks, and policymakers are forced to react. The signs of Stage 5 are also familiar. You see emergency liquidity operations, special repo windows, new funding facilities, creative programs with long acronyms. You see sudden shifts in central bank communication, as the language moves from higher for longer to data dependent and then to ready to act as needed. You see funding stress in banks, money markets, or shadow banking entities. You see volatility spike in both bonds and equities. You see clusters of defaults or distress in the weakest parts of the system: over-levered companies, speculative real estate, fragile funds. In every cycle, the weakest link breaks first. In 1994, it was leveraged municipalities and aggressive bond traders. In 2000, it was profitless tech companies and the capital that funded them. In 2007 and 2008, it was subprime mortgages and the complex products built on top of them. In 2013, it was vulnerable emerging markets. In 2018, it was equity valuations that relied on the assumption that the Fed would always flinch first. Today, the candidates for that weakest link include heavily indebted commercial real estate, lower-grade corporate borrowers facing huge refinancing needs, certain hedge funds, some regional banks, and foreign holders who are losing faith in U.S. bonds at current yields. The transition from Stage 4 to Stage 5 has historically taken anywhere from 1 to 6 months. It rarely takes longer. Once the system recognizes stress, the clock starts. So what can an informed observer do in a moment like this? This is not financial advice. But if you want to understand where the pattern is heading, there are a few indicators worth watching closely. Watch Treasury auctions. Are bid-to-cover ratios strong or weak? Are more dealers being forced to take down supply? Watch the Federal Reserve balance sheet. Is it shrinking as planned, or quietly stabilizing, or even expanding again? Watch money market funds. Are flows moving into safe instruments, or out into riskier assets? Watch the usage of repo and other funding facilities. Is the plumbing of the system calm, or are we seeing signs of stress? Watch corporate refinancing activity. Are companies able to roll their debt on reasonable terms, or are defaults and distressed exchanges picking up? Watch commercial real estate data, vacancies, delinquency rates, and valuations in offices in weaker sectors. None of these by themselves will tell you the exact day a crisis starts, but together, they reveal whether the system is digesting higher yields or choking on them. 3 truths define this moment. First, we have seen this pattern before: 1994, 2000, 2007, 2013, 2018. In each case, a yield spike after a policy surprise led to something breaking. Second, the United States is more indebted and more sensitive to interest rates today than in any of those earlier cycles. The margin for error is smaller, the cost of miscalculation is larger. Third, the Federal Reserve's message is clear: there is no automatic path to more cuts. A December cut is not guaranteed. If inflation refuses to cooperate, rates can stay higher for longer than markets want to believe. Maybe this time really will be different. Maybe policymakers will thread the needle. Maybe the system will absorb higher yields without a major accident. But patterns do not care about optimism. They care about incentives, leverage, and math. Right now, the debt system pattern is in stage 4, systemic stress recognition. The window to stage 5 is open. If this changed the way you look at the yield spike, and if you want to follow this pattern as it unfolds in real time, consider subscribing to Economy Base, because the next 90 days may not just move markets, they may help decide what the next decade looks like. I'm going to keep tracking the data, watching the pattern, and separating signal from noise. I'll see you in the next update.